Hello guys, glad to have you on board again today, Thursday quickie, talking about the S&P 500 mostly today, because yesterday had been an interesting session, sold at the open and sold at the close, so there has been kind of a shift in the sentiment, pushing prices right back to the latest supports, even though the Asian sessions has been positive this overnight session, and I don't think that the European session will be that trendy. So probably gonna stay there, and therefore we're gonna have a lot to talk about when it comes to what's gonna happen today in the US session. Big question mark, and it's going to be a big session to look forward to, not necessarily to trade, but look for the markets. We might have early clues about what's to come next week. Today. Okay, so what that means is that we're still facing this weekly huge indecisive cluster, squeezing the prices and the momentum. So we definitely have an overextended run in here. It is about time to be very cautious dealing with these markets. But most importantly, understand that these things, okay, when you have such high level of uncertainty on both the metrics I tend to follow, cycles, momentums, and prices, basically I have no reliable technical information coming from the weekly charts until we actually destroy either prices or volatility, or we have to get somewhere out of these clusters to actually have something to trade. But most importantly, okay, that means I cannot trade efficiently out of these time frames because they are too tricky to speculate on. But that also tells me another thing, that there is a confluence of elements confronting each other around these time frames. Generally, that one of the time frames above, either be it monthly or quarterly, is contradicting the daily or 4-hour. To make it plain simple, the weekly uncertainty we have is the confluence of element that the daily chart is excessively bullish, facing an overextended and bearish taint over the monthly chart, and oh boy, congratulations, here is what we have in the monthly chart. Of course, this candle still has 11 days to close, so please don't anticipate bad stuff. It's definitely never have been a good choice over the latest few years. Of course, things may change, but until then, you need to wait for the goddamn candle closes and understand that as long as the weekly uncertainty is maintained, well, the monthly closes will certainly not necessarily give us the answers we're looking for. But looking at what it is now and today, which is not closed, it doesn't look that pretty. And we've already talked about that months ago when we said that the monthly structure is pretty damn fragile. And in that perspective, we don't want to be overextendedly bullish and certainly do not follow the sentiment in the market. When the market is going for crazy overbought sentiment, meaning greed and extreme greed, it is an appropriate time to lock on the fucking gains instead of being boosted for more. Okay? But still, as long as the signal isn't closed, don't go there. But if it did close like that, not a good sign. Certainly not a topish sign. These means the momentum is overloaded like crazy, and these are normal behaviors in bullish trends. So we are in a bullish trend, and there probably will be all-time highs further down the road in the monthly chart, but it also tells us this is not an appropriate time to buy at resistance prices. It's an appropriate time to look on some partial gains and to rotate or some other things, but to basically wait for supportive prices to be traded. If we do get a monthly retracement, the bare minimum to wait for is 3,800, because we at least need to wait for 23% retracement prices, okay, to get a suitable buy price. The weekly chart doesn't tell us that much, okay, but targets to the same areas. We get the 38% retracement cluster over these areas, and even if we go there, the 20% mark, which will load up on the bear market signs all across the board, doesn't mean anything. Remember that the bear market is minus 20% at least, and it has to be correlated with the asset's volatility. As for example, the bear market isn't 20% retracement on Bitcoin, it's pretty much 40%. But for the S&P 500, it is a 20% mark that we generally assume to be as a bear market territory. But it also requires the second big information everyone's always forgetting about. We need to have negative market tops and negative market bottoms, basically lower lows and lower highs, which we'll very likely not get. If we ever dip down to 3,800, I think we're going to still maintain ascending bottoms afterwards. Okay, still, though the daily chart, which is very bullish, okay, compared to the very huge weaknesses we have on the monthly chart, but do not maintain candle closes so far, is the fact that, well, we are finally getting closer to the daily fucking support context. That the first time in a long time that we're actually actively closing below 50% context. So we're actively entering in bearish pressure territory. Reason number one, that I am not buying these supports. You might be doing it. I personally think this is very, very dangerous. That's the first time we have legitimate bearish pressure in Wall Street. So I'm really paying attention a lot more to supports than I was looking for resistances previously. So what that tells me is that I'm looking for supports to profit fucking take, which means I have my cover trades and I will not take profits until we at least get to 23 or 38% retracement. So you got my first and second taking profit layers for my cover trades, pure and simply. These profit trades, if they ever tend to get to their profit takings, were never meant to profit from downside opportunities. They will just assess and cover for portions of losses that I will take on the portfolio, because of course, if the market goes down, most of my assets will go down as well. And therefore, these gains that I'll make with the cover trades will only be there to cover the losses that I will take on the rest of the portfolio. So I'm actively not going to make myself richer. I'm just going to make myself less of a poorer person, okay? So understand it that way. It has never been the case of trying to profit to the downside, and still isn't right now, because we are in support territory and I'm definitely not going to sell out of these prices, okay? So I have covered the portfolio, and right now I do not have a suitable technical situation to try reinforcing these positions. If the market rebounces, I'll eventually consider doing such a thing, but it is too late. We had a delayed third range boundary on the lower chart time frame, okay, context to context, rebouncing without making new highs, and now we've broken down. So it is too late now to load up on added bearish positions, but I definitely do not think it's worth buying these supports. And it has happened so much in the past. I mean, I've been proven so much wrong that I'm certainly not going to say that you guys cannot buy. But oh boy, one day it will not work, and you rather like not to buy the last time before it worked, before it fails. So we had the double bottom multiple times in the past. Are we gonna get another one? I don't know, but I certainly do not bet on this side of the equation. Okay, so I'm really getting cautious with this. Lots of assets are sending some very worrisome signals, not to mention the big boy Apple, which has been closing the day below the previous supports. I mean, just look at the gorgeous monthly structure. Oh boy, if this is a trend, you're really gonna have to learn about market valuation metrics, because oh boy, even if you look at the chart itself, which is a parabolic skimming shit that I've rarely seen, all of the market valuation metrics are excessive monthly chart referring, okay? Look at the volume distribution. This is not a trend. This is a bubble, boys, and when we'll fuck it all up, we'll go right down to where we left some volume. Bare minimum will be $40 for an Apple share. So you might not want to buy that shit. I'm not saying that you want to short it. This is for professionals only, but same thing goes in. If we get a taking profit pattern on the monthly chart of Apple, not going to be pretty retracement stuff, okay? Of course, it's not necessarily going to crash down to $40 in a couple of months. It's going to take years, possibly even decades, to go right down there. But if Apple makes a top, it's going to be the top forever. They can try selling glasses or whatever bullshit vehicle that will be. Apple is over. If they reverse the monthly charts, they're going to suffer withdrawal effects. Until then, that's going to be it for today. Cryptocurrencies, I'm going to make a quick look at it, okay? But don't make it over complicated for you guys, okay? Until further notice, they have not given any reliable information. We are dealing with support prices on the daily charts as well, and lots of people are trying to make irrational correlation studies between the stock market and crypto market, saying that, oh boy, if the stock market finally breaks the supports, then cryptos will have to break the 40K mark and so on. This is bullshit. Really, really. Don't get me wrong. Everyone who's trying to pull out some kind of correlation study between these two asset classes, they really have to work out their math a lot better down the future, because this is really making nonsense. To make it pure and simple, either these guys are wishful thinking their stuff, which means they're trying to find the appropriate context and time frame in which they can find the highest possible correlation numbers, And even though they work so hard to get the highest numbers, these numbers are below 50% correlation. So this makes no sense. We cannot technically use those correlation numbers. They are statistically insignificant, period. No matter how hard you try to find that, it's not yet the case. The only thing we get is definitely a tendency, a trend toward bringing eventually a correlation down in the future, but it's certainly not going to be that easy type of correlation as people would like to. Correlations are not static. They generally tend to oscillate across time. And don't get me wrong, I definitely think the increasing correlation that we have now is temporary. It might last for a few years ahead, at best, a few quarters, but definitely going to reverse at some point. Bitcoin is a hedge against inflation, and I don't nearly think the S&P 500 is that much. It is as well, because inflation will price in the S&P 500 more expensively. But the thing is that Bitcoin has still 10 years growth ahead, where I don't nearly think that the S&P 500 has that much growth for the years to come. Stagflation is my plan, therefore reduced growth output. Still, okay, other stuff that people need to figure out, okay, they might be a correlation on a candle-to-candle basis, and it's still very limited, statistically speaking, but more than that, if you want to correlate two assets, look at their fucking cycles. Look at Bitcoin, terminated 2 cycle, finished 2 bullish cycles as well in between, okay, and we've broken there and broken there. Just look at the S&P 500, for example. Okay, in here, what did we do? Okay, we've broken much more lately. Okay, the breakout is out there. There's certainly not any single bearish cycle terminated. So the cyclical activity of these markets, okay, is absolutely not correlated. So you can try to study the correlation on a candle-to-candle basis. Basically, is the candle going up on both markets, then the correlation increases, or do they go on opposite direction, then it decreases? This is statistically irrelevant to talk about correlation between these two markets because they do not even have correlated cycles. So, first of all, wait for prices to correlate themselves, and then, and only then, we can talk about correlation. Okay, there is no correlation between the S&P 500 and Bitcoin. There is correlation between some assets in the S&P 500 and Bitcoin, and most of these are in buyable territory. So I definitely think that the S&P 500 can go down just because of the apples and the overweighted stocks that may suffer withdrawal effects, and this is a big may, not something you want to profit from. And even if it happens, well, there are so many other sectors that can take this money without a problem. There are some oversold sectors that can provide growth in the future, not to mention the biotech sector or some aerospace, like Virgin Galactic has been slashed. It's costing $9 now. So there's definitely some areas in the market that can bridge in the money that could go out from apples and big names that could suffer withdrawals. That being said, the withdrawals haven't even yet started, so don't anticipate, guys. S&P 500 is on supportive territory, and like I said, these supports have surprised me a lot in the past. I wouldn't be surprised if they do it one more time, though I'm not buying these supports, but I'm certainly not selling out there either. I'm letting the market making its choice, but look at the market. This was today's message. The big elephant in the room is the dollar, okay? If you want to try figuring out what the hell is going on for cryptos against the stock market, the big boy is dollar. So don't make this stupid correlation between the S&P 500 and the crypto market. If you want to have a bullish crypto market with a negatively tainted stock market, the only elephant in the room that will make that happen is the dollar going down. That's pretty much all about it, okay?